We're living in times of financial and economic turmoil. Things are changing. We've got uncertainty ahead of us. So in today's show, I want to go back to the big picture and discuss 24 things all investors, business people, entrepreneurs must understand about how the economy works and how property investment works. Now, this is a great show. Now, I know because I've pre-recorded it, had a lot of fun doing it. At the end of today, you're going to have learned a few interesting things that I hope is going to make you a better investor. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the 5th time he's won a similar award in the last 7 years.
Over the years, one of my favourite columnists that I read regularly was Morgan Housel, who wrote regularly in Fool.com about behavioural finance and about the psychology of success. And he's since moved on, but I remember a great column which said 122 things everyone should know about investing in the economy. There was some big picture lessons to learn from that. So I've pulled out a few of these thoughts today and plan to have a chat with them with Ahmad Imam, Director of Metropole in Sydney. Hi, Ahmad.
Hi, Michael.
Now, I've given you the list of these great thoughts that Morgan Housel came up with. So why not read them out and let's have a chat about them and see what we can learn from other investors.
Yeah, sure. There's some pretty interesting thoughts here, so it'll be good to get your opinion as well. Okay, so let's start from the beginning. Saying I'll be greedy when others are fearful is easier than actually doing it.
That's right. Look, we all heard Warren Buffett's great quote, be fearful when others are greedy and be greedy when others are fearful. But look what's happening in the market at the moment. The media is scaring us. The headlines are scaring us. There's a boogeyman around every corner. And I know I'm finding that clients are coming worried when they shouldn't be. This is the time they should be greedy. What's your experience on the ground?
Yeah, I'm experiencing the exact same thing. I think market sentiment is at an all-time low. Consumer confidence is at an all-time low. I think some of the things that we're hearing in the media is justified and majority is not. So we just need to put things into perspective, I think.
And again, the message is if you're a long-term investor, and that's the only way you should be, this is the time to take advantage of it. So be greedy rather than be fearful. But Morgan Housel's comment was right, wasn't it?
Yeah, I agree with that one. Okay, so when most people say they want to be a millionaire, what they really mean is, I want to spend $1 million. And that's literally the opposite of being a millionaire.
I guess what he's getting at there is that true wealth is the assets you own rather than how much you spend, because there's something called the wealth creep. As you earn more, you spend more, and very few people tend to accumulate, to save, to invest, and to have assets. So yes, we all want the trappings that go with being a millionaire, the nice cars, the nice watches, the holidays, but very few of us are prepared to do what it takes to get there, to get a big enough asset base to end up with the ability to spend $1 million.
You know, I heard from someone the other day that if you want to be wealthy, you need to have 2 genes. You need to have the working gene and you need to have the saving gene. And I think this applies in this case. It's not just a matter of getting $1 million and spending it. You have to understand how to make it and how to maintain it.
That's a really good point. And of course, we also know that true wealth isn't about how much money you've got or how many properties you've got or how fancy your cars are. It's to do with your health, your family, your relationships, your ability to enjoy your life and gratitude. But yeah, we all want to have a little bit extra and enjoy life. That's good.
Yep. This next one's important. Daniel Kahneman's book, Thinking Fast and Slow Begins. The premise of this book is that it is easier to recognize other people's mistakes than your own. You know, and this really should be every market commentator's motto, in my opinion.
That's an interesting point. There's something called the Dunninger-Kruger effect, and this is no disrespect on anybody, but the comment is that dumb people are so dumb they don't recognize they're dumb. In other words, I'm sure there's all people that we deal with in life who, I mean, we all want to be none of us want to do illogical things or wrong things. In general, people are nice people, but we actually have difficulty recognizing our own weaknesses. And it's so easy for us to look at others and say, why is he doing that? How on earth could he be thinking that way? Why is she doing this? When in fact, to them, it's all very logical. So as often is the theme of the Michael Yardney podcast, as rational people, we actually act very irrationally when it comes to money.
Agreed. Okay, so Eric Falkenstein says, in expert tennis, 80% of the points are won, while in amateur tennis, 80% are lost. And the same is true for wrestling, chess, and investing. So beginners should focus on avoiding mistakes. Beginners actually focus on avoiding mistakes, while experts on making great moves. What are your thoughts on that?
What the message here is that it's actually the same as Warren Buffett's first rule, don't lose money. So beginning investors should concentrate on getting it right, on avoiding mistakes, on finding a proven system and learning and becoming an expert. Once you become an expert, once you got the basics, the fundamentals under control, then you can try fancy things. I see, unfortunately, especially at this stage of the market where the market's not doing the heavy lifting, people trying all sorts of things like granny flats and the next hotspots and funny ways of trying to make money out of property, and they forget that it's the fundamentals that are going to make them wealthy, Ahmad.
It is the fundamentals, and I think people are trying to get very creative right now in a time where we're not seeing strong growth, and it's really just a matter of using those fundamentals and having a bit of patience, I think. The next one, and this one is more about predictors. So there's a difference between he predicted the crash of 2008 and he predicted crashes, one of which happened to occur in 2008. And I think it's important to know the difference when praising investors.
So many commentators. I mean, there's 25 million property experts around Australia. All of us have got an opinion on what's happening with property, but you and I have seen it over and over again. Those who go out and put their necks out and make recommendations, make forecasts, predict what's going to happen in the market, most of them are wrong. And then they get one right. And they say, I'm the first one who predicted Hobart, but they've forgotten all the other 50 predictions that they got that are wrong. So I think the lesson from this is nobody really knows what's going to happen in the property market, because while the fundamentals are really easy to pick, you can do research on population growth, on economic growth, on inflation, on where you think interest rates are going to be. The one thing that the experts can't quantify is human emotion. So fear and greed drive our markets, which means that during booms, we overshoot the mark, and during downturns, we go in the opposite direction, and fear of buying early and fear of getting in when the crowd isn't doing it makes the market go down more than it should. And of course, that creates opportunities for those investors who don't think that way. But I guess the message is don't look at the gurus who say, I got it right.
Agreed. I think we always think about maybe 5 or 10 of the predictions that Nostradamus has made. And he actually made thousands upon thousands of predictions that were completely irrelevant and wrong. So I think this goes to show for property predictors and forecasters as well. Okay, next one. Wealth is relative. I remember I saw Chris Rock do a bit of a stand-up skit, Michael, and he said a very interesting line, and that is, if Bill Gates woke up with Oprah Winfrey's money, he'd jump out the window.
Yeah. So I think the lesson is don't compare your chapter 1 with somebody else's chapter 30. You're maybe still a beginning investor, and don't compare your life with the highlight reel that people put on Facebook and Instagram. They don't tell you about all the errors. They don't tell you about all the mistakes. That's the highlight reel. But all you look at is all the mistakes that you've got on the cutting room floor. Don't compare yourself to others. Agreed.
You should only be comparing yourself, to the you of yesterday, and just aim to be better than that person. I think that's the only way you can move forward correctly. Okay, the Financial Times wrote, in 2008, the 3 most admired personalities in sport were probably Tiger Woods, Lance Armstrong, and Oscar Pistorius. Okay, so the same falls from grace happen in investing, which the lesson here is to choose your role models carefully.
Once a year, I sit down with an old mate, Rob Belander from Queensland, and we pull out the old copies of Australian Property Investor magazine that's now defunct, and we play the game, where are they now? And we look at all the ads for the full-page ads for the gurus. Often they've got big red Ferraris or shiny toys or yachts, and they tell you how good they are. And most of them are not around anymore. So you're right, Ahmad, the lesson from this is pick your mentors very, very carefully.
Correct. Okay, so investor Nick Murray once said, time in the market is a fool's game, whereas time in the market is your greatest natural advantage. So remember this the next time you're compelled to cash out. And I think this is very relevant to this current market, isn't it, Michael?
Very much so. So in the property market, and you'll remember at the end of last year, I did a masterclass on how important timing is in the market. And I showed some graphs that our research department did showing that even if you got the timing, the best time after the global financial crisis, you didn't buy right at the peak of it, you bought right at the bottom, which you couldn't have done before the market went up because you wouldn't have known the right time. But even if your crystal ball got it right, 10 years down the track makes little difference. Much, much more important is owning the right asset and staying in the market. So don't try and be smart and time the market because nobody can, the experts can't.
Absolutely. I can't tell you how many people I've seen that have spoken about, had they held onto their particular property that they sold 10 years prior, how much of a different position they'd be in. So it is really just a matter of having that patience, not cashing out and making sure you've got those buffers in place.
Very much so. And it goes back to the first quote that you mentioned earlier on, be greedy when others are fearful. It's so hard for us as humans to invest counter-cyclically. It goes against the grain.
Yeah. And don't you find, Michael, that most people are fearful right now and most people are in a position where they're looking to sell? So it's important not to follow the crowd in these cases. You really have to follow the people that have done it before, not the average person that you're talking to at a barbecue.
You're right, because if you do what everyone else does, you're going to get the same results they do. And we know that the average investor never gets past their first or second property. So I fully agree. Be greedy when others are fearful and stay in the market.
Yep. Next one, Jason Zwig writes, the advice that sounds the best in the short run is always the most dangerous in the long run.
Now, that's interesting, isn't it? Almost enough said. I'm not sure that we can say a lot more about it other than there's no such thing as get rich quick. Our system of getting wealthy through property is too simple for the average investor, too simple for the educated people. They come along and say there must be more to it than that, and they look for all these fancy things when no, you don't have to. Just stick to the fundamentals, Ahmad.
Yep. Billionaire investor Ray Dalio once said, the more you think you know, the more closed-minded you'll be. So repeat this line to yourself the next time you're certain of something.
Of course, that's such a basic human way of thinking about things, but it can get us wrong. So if I believe, and I know I have this discussion with our IT tech guys all the time. I'm very much into Apple. I've got Macs and iPads and iPhones, and they're very, very much into Samsungs, and they can give me all the arguments while they're right, and I'm not prepared to listen to them. And I can give them all the arguments why I'm right, and they're not prepared to listen to me. So if you are so set in your ways, you're very likely to miss out other opportunities. And this has just as much to do with investment philosophies and property strategies, Ahmed.
Yeah, I 100% agree with this one. It's something that's actually very important to me as a personal value. Just the concept of being forever a student, constantly learning regardless of what you know. And one thing I admire about you, Michael, is at your age, after having been in the industry for so long and being at, can I say, the top of the industry, you're still reading property investment books, you're still reading blogs, and you're still educating yourself. And
I'm reading people with different opinions to mine because I am open to considering other ways of doing things. When I stop doing that, I'm not going to grow anymore.
Yeah, exactly. Okay, so moving on. John Reed once wrote, when you first start to study a field, it seems like you have to memorize a zillion things. You don't. What you need is to identify the core principles. generally 3 to 12 of them that govern the field. So the million things you thought you had to memorize are simply various combinations of those core principles. So we have to keep that in mind when we're getting frustrated over complicated financial formulas or different types of perspectives within property.
Good point for beginning investors. It's so easy to get overwhelmed. So there's a lot of information on the internet. The problem is too much information, much of it incorrect. Choose your mentors carefully. Start with the fundamentals. Start with the principles. They're reasonably simple. Only buy investment grade properties. Invest for capital growth. Real estate investing is a game of finance with some houses thrown in the middle. So understand how finance, tax, the law relates to it. And you can then add to your knowledge down the track.
The next one is pretty simple, but I really like this one actually. It's James Grant's quote, and it's, "Successful investing is about having people agree with you later."
That's funny, isn't it? So no, most people won't agree with you now. They're only going to see later that you've done the right thing. It's relevant to a lot of the things we've already spoken about, that those people who are prepared to take action today, in 5 years' time, in 10 years' time, are going to look smart, just like those of us who bought during the global financial crisis. I remember those times well, just about 10 years ago, because in 2008, we opened our office in Sydney, the Sydney property market, and our clients were buying there. They were buying 2-bedroom apartments in the inner western suburbs for less than $300,000 because people were nervous about the global financial crisis. Look what they're worth today. People agree with them now. They didn't agree with us and our philosophies then.
Yep, yeah, very true. Scott Adams writes, "A person with a flexible schedule and average resources will be happier than a rich person who has everything except a flexible schedule." So step one in your search for happiness is to continually work toward having control of your schedule.
Psychologists show us that the more we feel in control of our lives and various elements of our lives, the happier we're going to be. And there's certain things we can control, and there's a whole lot of things in our world that we can't control. So learn to be comfortable looking after the areas that you can look after, be in control of, and don't get too frustrated when external things happen that are out of your control.
Well said. Investors want to believe in someone. Forecasters want to earn a living. One of those groups is going to be disappointed. I think you know which.
Ahmed, I don't think I even need to make a comment about that one. I think it is so beautifully said that anything further I would say would spoil the message.
Agreed. Okay, next one. As the saying goes, save a little bit of money each month, and at the end of the year, you'll be surprised at how little you still have.
These are amazing quotes. They're very good, and you can see why I saved them and wanted to share them, because if you want to save and then invest, you can't just save a little. What you've got to do is have a money management system that, just like the government, takes the tax out before you get paid because it knows you're not going to be able to pay it at the end of the year. Just that's the way we work with our finances. You similarly should take a fixed amount out. A lot of people suggest it should be 10% of your earnings should go into savings to eventually invest. In my suggestion, if you're starting off, it needs to be even more than that. Otherwise, you'll never have a big enough asset base.
So your suggestion is take, let's say, 10 or shall be 20%. You put it
more
aside.
Like 20. Yeah, more like 20.
Yeah. And you put that aside and then you spend whatever's left over.
That's right. Do it in that order, not the other way around.
Sure. Okay. John Maynard Keynes once wrote, "It's safer to be a speculator than an investor, in the sense that a speculator is one who runs risks of which he is aware, and an investor is one who runs risks of which he is unaware."
That's interesting because many of the people that we see coming to us at Metropole think they're an investor when they're not. They're a speculator. They look for the next hotspot. They chase the next big thing. They're looking at what's working now at this climate rather than what's always worked, and they think they're investing. On the other hand, I guess the message here is if you at least accepted that you are a speculator, you wouldn't be as badly off. So when you go to the roulette table, you're a speculator. It's either red or black, or it's one of those 36 numbers on the roulette wheel. You know you're gambling. But with investing, too many people are gambling with their money when they should be investing.
Yeah, agreed. I think we're able to, with experience and perspective, of course, mitigate every controllable risk. There will always be those risks that we can't control, but mitigating the controllable risks makes you an investor as opposed to a speculator.
Well said.
Our memories of financial history seem to extend about a decade back. To the quote, "Time heals all wounds." It also erases many important lessons.
Ahmed, every property cycle or share market cycle or economic cycle brings with it a whole generation of new investors. So firstly, they're the ones that drive the property booms. The property market is driven by owner-occupiers moving, buying homes, selling homes, living, but the booms are driven by investors who get carried away. So there's a new generation of investors. Unfortunately, they suddenly become nervous and upset and scared as they are now when the market suddenly scares them and doesn't do what they expected last year. Having said that, over time, they're going to forget that and they're going to speculate again a decade down the track. That's just the way our mind works.
Yep. This is an important one, this next one. You're under no obligation to read or watch financial news. If you do, you are under no obligation to take any of it seriously.
Good point. I think a lot of people believe that they are the client of the media, that the media is looking after them. That's not the case at all. The media's client is actually the advertisers. So they're wanting more people to click on the websites or view the news or read the papers. So they're going to give the information that gets the most clicks, the most views. So the financial media is not looking after your interests.
Yep. One of my favorite quotes, Michael, is, "If you don't read the newspaper, you're uninformed. And if you do read the newspaper, you're misinformed."
Well said.
The next one, most economic news that we think is important doesn't matter in the long run. Derek Thompson of The Atlantic once wrote, "I've written hundreds of articles about the economy in the last 2 years, but I think I can reduce those thousands of words to one sentence. And that is, things got better slowly."
Interesting, isn't it? So we have to produce lots of content and property update every day, and we get it from a whole lot of experts. But imagine if you were the Financial Review or the Australian or TV, where you've got to continuously come up with new information. I think Derek Thompson was right. Very little of it is important when you look down the track, but when you watch it at the time live, boy, does it seem important. And sometimes it seems scary.
It does. And a lot of what we're seeing now with what we're getting in terms of updates about changes to the market is really only important to traders, people that are trading property right now. You know, if you're buying a property looking to sell it in 2 years' time, yes, what's happening over the next 6 months is going to be important to you. If you're a long-term investor, it actually makes very little difference.
That's a really good point. If you're a long-term investor, all these ups and downs don't make any difference at all. And I know some people have just started to turn off the financial media. They don't want to get caught up in that.
Yep. Next one, there is a strong correlation between knowledge and humility. The best investors realize how little they know.
The market tends to humble you. When you think you know it all is exactly when you're going to get yourself into trouble. So I agree with that quote. Be humble and recognize that you can always learn.
Yep. Not a single person in the world knows what the market will do in a short run.
We've already explained that most economists get it wrong because they're looking at the fundamentals, and the markets are very much driven by human emotion.
So the next one, Daniel Kahneman writes, "The evidence is unequivocal. There's a great deal more luck than skill in people getting very rich."
I know my first investment that was the springboard for my very substantial portfolio was made at the right time and in the right location, but not because I knew the time was right and I knew the right location. It was just luck. And the worst thing that can happen to a beginning investor is get it right first time because they think they're smarter than they are. And that's exactly what happened to anybody who bought a property in Sydney or Melbourne over the last property cycle during the boom. They could go away on holidays, and when they came back, they were much richer than they went away with. And it wasn't because they were smart. It was just because they were lucky.
Very true. The next one, Michael, the more someone is on TV, the less likely his or her predictions are to come true.
interesting comment, Ahmad, because I remember years ago seeing the people that were written up in what used to be a magazine, monthly magazine, the Business Review Weekly, BRW, and all these successful new hotshots. But it was fascinating to follow where they were a couple of years later, and we decided we don't want to be written up in that magazine because all that's going to happen is we're going to go bankrupt. Much the same with some of the people who end up on TV. They love giving their messages out in the media, but you just got to be careful who you listen to.
Yeah, and I think the name Harry Dent comes to mind, Michael.
You're right.
Next one. How long you stay invested for will likely be the single most important factor determining how well you do at investing.
Ahmad, there's been lots of studies showing that the sooner you start and allow the effects of compounding and leverage and time to work, the more wealth you'll have. We've all read those sort of stories where if somebody started investing at 25 and only did a little bit and then actually stopped at 35 and just let compounding work, they were better off financially than somebody who bought their first property at, 50 and then started to try and build a big portfolio. So time in the market, if you own the right assets, makes a difference. So rather than timing the market and getting it right, I think the message from this is own the right assets, hold them in the long term, carefully review your portfolio. And property's a great way to create wealth in Australia if you follow those rules.
Well said, Michael.
So thank you, Ahmad. We got through 24 interesting quotes that Morgan Housel wrote in his article of 122 things every investor should know. I learned a bit from that. I really enjoyed our chat.
That was fun. We should really do it again.
Well, hopefully at the end of this show, you're now going to be a more informed investor. I guess the aim of me putting these shows together is to help as many people as possible become more financially fluent, understand more about investing, how the economy works, how money works, so they don't make the mistakes that the average investor makes. And I'd like to hear your feedback on how it's going. And I'd also like you to pass this message on if you know somebody, and you must know somebody who's also interested in investment or property. Why not pass the show on to them, help them step up as well. So tell them about it through Twitter, Facebook, a link, whatever, and also let the world know through the reviews. Interestingly, my show ranks highly, not just in Australia and New Zealand where I expected it to, but in multiple countries around the world. I can see that on the iTunes charts, and I'm very, very pleased. I also get reviews from around the world, but I'd like to read out 2 reviews I've received recently, 5-star reviews. And by the way, if you leave a review and when I read it out, I'm happy to gift you one of my books. So all you've got to do is email me at michael@metropole.com.au, michael@metropole.com.au, once I read out your review, and tell me which of my books you'd like. Now, Stephen just left a review actually before Christmas. It takes me a while to get through all these, saying, "Hi Michael, thank you for sharing your knowledge. The information is very valuable and timeless, and it helps people keep things in perspective. You call it as it is, and your achievements speak for themselves. There'll never again be anyone quite like you. Lucky to find you, Stephen." Well, gee, they're really nice words, Stephen. And yet there's lots of other people like me who are wanting to pass the message on, but I really appreciate the kind words. Similarly, Michael Maloney left a review. "Your podcast provided me with a broad understanding of property investment and, most importantly, highlighted the lifelong importance to never stop learning." That is a great lesson, Michael. Thank you, and keep up the great work. And also, just before Christmas last year, a 5-star review from Matt Van Bale, who said, "Very useful and educational content. I've listened to every show so far and will continue to listen. Keep up the good work, Michael." Thank you, Matt, and keep up the listening. I look forward to being back with you again next week with the next episode of the Michael Yardney podcast.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success, and money in around 30 minutes.